There are two changes happening inside TSPY and TDAC that every investor in these funds needs to understand because they make already strong products meaningfully more efficient. But before we get into the changes, let's talk about why these funds have earned attention in the first place, because the performance context matters for understanding why the construction behind them is worth caring about. Quick disclaimer before anything else, nothing in this video is financial, investment, or tax advice. I am not a financial advisor. Everything here is for educational purposes only. Please do your own research. TSPY and TDAC from Tap Alpha have now been live for approximately a year and 9 to 10 months. And in that time, they have navigated some of the most difficult environments for a covered call strategy to perform well, including sharp bull runs, geopolitical volatility, and everything in between. The reason they have held up as well as they have comes down to the zero-day options strategy at the core of both funds. Most income investors are familiar with the traditional 30-day covered call approach. You write a monthly option, collect the premium, distribute it, and repeat. The challenge with that structure in strong bull markets is that you are effectively locked into a position for the entire month. If major positive news hits overnight or over a weekend like a surprise geopolitical piece, a static 30-day position cannot adapt. The upside from that event is capped because the call was already written. Zero-day options solve this problem. With a zero-day strategy, the fund is essentially uncapped overnight and on weekends. When significant positive market-moving news arrives, the fund absorbs the upside first, then repositions. That single characteristic, the ability to capture overnight and weekend moves without being stuck in a month-old position, is a meaningful structural advantage in trending markets. It is one of the primary reasons TSPY and TDAC have been able to keep pace with or even outperform their underlying reference assets, the S&P 500 and Nasdaq 100 respectively, while also paying monthly income that is distributed with approximately 89% constructive return of capital classification. That means for most investors in most scenarios, there is no current year tax bill on that income. The tax liability is deferred and eventually converted to long-term capital gains treatment, a genuinely significant advantage that most competing covered call funds do not offer. The trade-off relative to lower beta 30-day strategies like JEPI is worth being honest about. A fund like JEPI has a beta of approximately 0.55, meaning it barely reacts to the market in either direction. That cushions drawdowns significantly, but it also means JEPI will meaningfully lag in strong bull markets. TSPY and TDAC are designed for a different investor profile, someone who believes markets will be higher in 5, 10, or 20 years, wants to stay fully invested to capture that growth, and wants meaningful monthly income layered on top of that participation. If short-term volatility is acceptable and the conviction is long-term, the zero-day approach has historically delivered a better total outcome during bull market cycles. Now let's talk about the Lift series T6 and TDAX because these funds are the more aggressive expression of the same thesis. T6 adds approximately 30% additional exposure to TSPY. TDAX adds approximately 30% additional exposure to TDAC. That leverage cuts both ways. You get more exposure on the downside and more on the upside, but an important nuance is that the leverage is applied to funds that already have a covered call overlay providing income and partial hedging. This is meaningfully different from buying a 2 times or 3 times leveraged ETF on a naked index. Those pure leverage products can mathematically destroy capital in sustained drawdowns to levels that make recovery extremely difficult. Here, the leverage is approximately 30%, sitting on top of a hedged income-generating strategy, which keeps the risk profile much more manageable than the headline word leverage might suggest. Canada has run this model modest leverage on hedged strategies for decades with strong long-term outcomes. Weekly distributions on the Lift funds add an additional income frequency that many investors have specifically requested. Now to the actual changes, because this is what you need to know if you currently hold TSPY or TDAC. The underlying holdings of both funds have been switched. TSPY was originally built using SPY, the SPDRS, and P500 ETF as its core equity holding. SPY carries an expense ratio of 9.5 basis points. Tap Alpha's management fee is 68 basis points. Total expense ratio for investors, 77 basis points. The switch moves TSPY's core equity holding to VOO Vanguard's S&P 500 ETF, which charges just 3 basis points. Total expense ratio for TSPY is now 71 basis points. That is a 6 basis point reduction, which sounds small until you consider it represents roughly an 8.5% reduction in the total fund cost savings that are passed directly to investors. TDAC made the same move, switching from QQQ at 20 basis points to QQQM at 15 basis points. TDAC's total expense ratio drops accordingly. For T6 and TDAX, the improvement is automatically amplified. Because those funds use total return swaps tied to TSPY and TDAC respectively, any improvement in the underlying fund's efficiency is multiplied by the additional exposure. Investors in the Lift series get a bigger proportional benefit from these cost reductions. Critically, and this is the key technical point, nothing about the actual options strategy changes. The options that TSPY uses are SPX index options, not SPY options. And SPX options can be deployed identically whether the fund holds SPY shares or VOO shares. The same is true for TDAC, which uses NDX index options regardless of whether the core equity holding is QQQ or QQQM. The liquidity profile is unchanged. The spreads are unchanged. The tax treatment under Section 1256 is unchanged. The only thing that changed is the cost of holding the underlying equity exposure, which is now lower, a straightforward improvement with no trade-offs. The way these funds were able to make this change involves an important structural detail. ETF naming rules require that 80% of a fund's assets align with whatever is in the fund's name. TSPY was originally called the TAP Alpha SPY Growth and Daily Income ETF, which legally bound it to holding SPY specifically. Getting out of that constraint required negotiating a licensing arrangement with S&P Global to rename the fund using the broader S&P 500 designation rather than the specific SPY ticker. That unlocks the ability to hold any vehicle that tracks the S&P 500 VOO, SPY, or even a direct basket of constituents if circumstances ever warranted it in the future. The share swap from SPY to VOO was executed as an in-kind exchange within the ETF structure, which means it did not trigger a taxable event for fund shareholders. ETFs have a structural ability to do these in-kind exchanges that individual investors cannot replicate in their own accounts, and it is one of the genuine advantages of accessing these strategies through the ETF wrapper. On the distribution philosophy, the approach TAP Alpha uses is what they describe as the peanut butter method, spreading income evenly rather than distributing every dollar of premium collected in high volatility months and leaving nothing for lower premium months. This produces the consistency investors in TSPY and TDAC experience month to month. The income does not spike dramatically in volatile markets and does not collapse in calmer ones. For investors who do not immediately need the income, the DRIP reinvestment option allows distributions to compound back into the fund tax efficiently. For investors who do need a financial milestone retirement income, a specific expense turning off the DRIP and taking the income is a clean option that does not create the tax drag it would in a taxable brokerage account holding a less efficiently structured strategy. On the pipeline of new products, a Magnificent 10 ETF and a Russell 2000 version are both filed and likely to launch in the near term. Semiconductor exposure and Bitcoin are on the longer-term consideration list. The founder's stated philosophy: do not launch anything that weakens the existing foundation, only add products that strengthen it by generating more data and feedback loops, is a reasonable way to think about why the Mag 10 makes sense as the next step. More indices, more data, tighter rules across the board. The summary for investors in any of these four funds is clean. The strategy is unchanged, the tax efficiency is unchanged, the distributions are unchanged, and the cost is lower. That is a straightforward upgrade with no downside. If you are not in these funds but have been watching them, the core thesis remains the same: growth plus income in a single tax-efficient allocation, built for investors who believe markets will be higher over the next decade and want to be fully invested to capture that, while collecting meaningful monthly income along the way. Subscribe to Dividend Desk for weekly coverage of income investing, ETFs, and market analysis. Join the Dividend Desk community, link in the description. We will see you in the next one.